All right, let's dive right into one of the biggest stories playing out in the Indian markets right now, what people are calling the PSU Renaissance. We're going to unpack how some of the country's oldest state-owned companies, the sleepy giants, are suddenly becoming market superstars. So here's the central mystery we're trying to solve today. How did this happen? How did these traditionally safe, kind of boring, dividend-paying stocks suddenly become the engines for what many are calling India's big CapEx super cycle? It's a massive transformation.
Now, to get to the bottom of this, we're not going to look at every single PSU out there. That would take forever. Instead, we're going to zoom in on 5 key heavyweights across banking, energy, and resources. If we can understand their stories, we can pretty much grasp the entire trend.
Look, this whole shift is not some random accident. It's really being powered by 3 core catalysts. You've got a revitalized banking sector that's ready to fund growth, a fascinating national energy paradox, and a huge government push to unlock hidden value. So let's break them down, one by one.
Okay, first up, the banks. And honestly, this might be the most surprising part of the whole story. The incredible turnaround of these public sector banks is really the foundation for everything else we're about to talk about.
To really appreciate this comeback, you have to remember the problem that plagued them for like a decade. The infamous twin balance sheet problem. It was this vicious cycle, right? You had heavily indebted companies that couldn't pay back their loans, which in turn crippled the banks that lent them the money. The whole system was just paralyzed.
And the change? Well, it's been dramatic. The decade-long cleanup has actually worked. Their gross non-performing assets, that's basically just a fancy term for bad loans, are at multi-year lows. The paralysis is over. These banks are now primed and ready to fund the country's growth.
And just look at this number. Canara Bank's net NPA, so the real bad debt left after they've set money aside for losses, is just 0.54%. That is an incredibly tiny figure. It puts them right on par with the very best private banks. The game has totally changed.
So with their books all cleaned up, their old structural advantage is now a huge weapon. I'm talking about their massive rural branch network, which gives them access to tons of low-cost deposits. In a world where money is getting more expensive, this is like having a source of cheap fuel when everyone else's funding costs are going up.
And for Canara Bank specifically, there's another catalyst that the market seems to be kind of sleeping on, and that's the upcoming IPO of its subsidiary, Canara Robeco. See, when a part of a big company lists separately, the market often has to reevaluate the parent company's worth. It helps get rid of that so-called conglomerate discount, where the whole company is valued for less than the sum of its parts.
Okay, let's switch gears and move to the energy sector. This is where it gets really interesting, because it's this fascinating balancing act between what India needs right now and what it needs for the future.
So this is the paradox. On one hand, India has to keep the lights on today, and that means reliable coal power. The PSUs are the guarantors of that energy security. But at the exact same time, the country has to finance a massive push into renewable energy. And guess what? PSUs are at the heart of that too.
Now, there was some chatter, some concern about a potential slowdown for the big power financiers PFC and REC, but their management has been super clear on this, saying directly that, and I quote, "the growth is literally already locked in." And here's exactly why they can say that with so much confidence. It's because of what they call their sanctions pipeline. Get this, a staggering 55% of the loans they have already approved or sanctioned haven't even been paid out yet. This means 11 to 12% growth is already baked in for the future. The money is just sitting there, waiting to be deployed.
And here's where it gets kind of wild. Despite this locked-in growth, despite the clean balance sheets, their valuations are almost illogical. PFC is trading at less than 4 times its annual earnings. REC is around 5. I mean, to put that in perspective, for every dollar they earn, the market is only valuing them at $4 or $5. It's a massive discount that just seems to defy logic.
So what could possibly change this? Well, it's the pivot to green financing. Both of these companies are targeting a 30% renewable energy loan book by 2030. When that happens, it should force the market to totally reevaluate them, to see them not as old-school lenders but as critical financiers of green infrastructure.
Next up, let's look at our third big catalyst, how the government is actively stepping in to force these giants to unlock their hidden value. And Coal India is the perfect example here.
The plan is actually pretty simple and really powerful. The government is basically telling Coal India to break itself up to unlock the value of its individual parts. It's going to start by listing its coking coal business and then all of its other subsidiaries over the next few years. This whole strategy does 2 really important things.
First, it directly attacks that conglomerate discount we talked about, forcing the market to value each piece on its own. And second, it makes Coal India an incredibly compelling story for investors. You get both income and growth, especially when you factor in that massive 6 to 7% dividend yield.
Okay, so we've seen the banking reboot, we've seen the energy paradox, and we've seen the government's push to monetize assets. So let's tie it all together and figure out what this group of stocks actually gives you as an investor.
What you end up with is a really balanced portfolio. On one side, you've got a defensive core, with those high dividend yields from Coal India, PFC, and REC. That gives you stability and income. And on the other side, you've got a powerful growth engine with banks like Bank of Baroda and Canara, which are just perfectly positioned to ride this coming credit and capex cycle.
Now, it's not all sunshine and roses. There is one potential headwind you got to keep on your radar. The Reserve Bank of India has some draft guidelines on project finance, and the final wording of those rules could impact how much capital PFC and REC need to set aside. So that's just something to monitor.
But here's the bottom line. With their low valuations and solid earnings growth, these look like deep value plays, not value traps. There seems to be a major disconnect here. It feels like the market is still pricing these companies based on historical problems, like the old bad loan crisis, that, for the most part, have already been solved.
And that leaves us with one last, kind of provocative thought to chew on. If a company's true value comes from its growth and its assets, how long can the market really ignore a stock that's trading at just 4 times earnings, while it's also transforming into the key financier for a 500-gigawatt renewable energy dream? That gap between perception and reality might just be one of the biggest opportunities out there.